Welcome to RAIN, the Real Estate Investor Growth Network with your hostess, Jen Josie. Join like-minded real estate investors and accelerate your business towards greatness. You will hear step-by-step strategies for success, interviews with real estate rock stars, and we will dig deep into past projects where we bear it all, including the good, the bad, and some just plain ugly. So get excited. Here's the bestower of badassery herself, the real Jen Josie. Listener discretion is advised.
Hi, and welcome back. I'm Jen Josie, creator of RAIN, the Real Estate Investor Growth Network. Whoop, whoop. On today's episode, we have a guest that will be sharing their badassery. But before we begin, here's today's badassery bestowment, a little badass gift to you. Today's topic is understanding the BRRRR method. RAIN Nation, if you've been in real estate for more than 5 minutes, you've definitely heard the acronym BRRRR thrown around. But do you actually know what it means and how to use it? Let's break it down. Number 1, buy. You purchase a distressed property below market value, one that needs work. The discount is where your equity begins. No discount, no deal. Number 2, rehab. You renovate the property strategically, not your dream renovation, an investor renovation. You're updating what matters to renters, appraisers on a budget and a timeline. Number 3, rent. You place a qualified tenant and start generating cash flow. This step proves the property is performing before you ever pull your money out. Number 4, refinance. Once the property is stabilized, you go to a lender for a cash out refinance based on the new higher appraised value. Done right, you can pull back most of your original investment. And number 5, my favorite, repeat. You take that capital and do it all again. The BRRRR method, executed well, is how investors build portfolios without starting from scratch on capital every single time. So, RAIN Nation, remember this. The BRRRR strategy is powerful, but it requires discipline, good numbers, and a solid team. Master the fundamentals first, then BRRRR your way to the badass portfolio you're building. Now, on to today's episode of the Real Estate Investor Growth Network podcast. Today's guest is Tom St. John, founder of NorthCorp Capital, LLC, a private capital allocator and fund management firm based in Toledo, Ohio, with over 20 years of experience in real estate and private markets. Tom's story is one of resilience, reinvention, and hard-won wisdom. His journey began in 2025 when his father suffered a heart attack on a golf course and was forced to retire with little to show for 32 years of work. That moment set Tom on a different path. He dove into real estate, built a single-family portfolio, and then made a bold move. He auctioned off 9 houses to fund his first multifamily deal and never looked back. But the road wasn't easy. He lost his brother, who had served as maintenance manager in a tragic car accident, forcing Tom to learn every aspect of property operations on his own. He later lost 6 figures in his first limited partner investment by choosing the wrong operator, and that hard lesson transformed him into one of the most thorough due diligence practitioners in the industry. Today, Tom serves as a fund manager, guiding accredited investors towards expertly vetted operators and deals across multifamily, real estate debt funds, and private credit. It's my pleasure to have him on the show, so welcome, Tom St. John. How are you?
Good. Thanks a lot for having me, Jen. I don't know if I could live up to that introduction, but here we go.
Well, first, I'm so sorry about all the losses. And I kind of want to start there because that's really where your story starts. And so let's go back to that 2005 when your dad had a heart attack on a golf course. I was forced to retire. So take us there. What did you see in that moment? And how did it change your trajectory in your life?
Yeah. I just got a call from my mom that he had a heart attack and he was okay and everything, and we went to visit him in the hospital. And I remember he just told my mom, like, whatever we got, we got. We're just gonna have to deal with it. We're
Is your
done.
dad still with us today?
He still is, yeah.
Okay.
Yeah,
Good.
he
Good, good,
still
good.
is. It's 80,
You
80s
need
now.
to add that to your bio, by the way.
Oh, okay. Yeah, that's a good point. I should do that. But yeah, he retired and he was glad he did. I mean, he made it work, but it was a few weeks after that, maybe 2 weeks, that this package came in the mail, and we never got anything in the mail like that big.
And what
And
did he do?
he was a plant manager at a power plant.
Okay.
So 32 years of breathing in all that coal dust and fly ash just kind of caught up to him. And so anyway, we got this package and opened it up, and it was this telescope. I thought maybe he bought it like it was a hobby he was going to start doing, but he's like, no, this is this is what the power plant gave me as a retirement gift. And so I think I was just at that age, like 22, 23, that just infuriated me. So that telescope, I look back on it a lot as like a changing or an aha moment or a turning point in my mental shift. And I just thought that telescope just represented to me what 32 years of doing what you're supposed to do or doing what people tell you to do will actually get you. Investing in the stock market, raising kids, and hope counting on a pension or a 401k to produce for you. And my dad wasn't anywhere near what he thought he would be after 32 years and moving up to become actually the plant manager. So
Ugh.
I look back at those moments in life that people say like the fork in the road, and mine was definitely like just looking at that telescope alongside my dad after all those years.
Oh my goodness. I actually can remember when my father passed away. I was 22 when my father passed away, and he worked for the Fort Lauderdale News Sun Sentinel, and he got a, a watch sent after he passed because he was supposed to retire right around the same time. So we still got a watch. So a
Yeah,
telescope and a watch. My goodness.
yeah,
Like you're bringing me back to I can totally feel exactly what you went through, and I can see how that just would absolutely change your trajectory. So
yeah. I just thought I knew I had to go to work and get a job and do all that stuff, but I just in the back of my head, I knew I had to find another way. And my only option at that time, I didn't really have any mentors or anyone that even owned a business, so I just went to the library and I just read books, hundreds and hundreds of books.
oh my goodness, I would have made a telescope my icon for like my business moving forward.
Yeah.
I'm just like that really, oh my goodness. So you go to the library because I how long ago was this?
2005, so just over 20 years ago.
Okay. So before YouTube and all that
That's
stuff.
that's
Yeah.
the thing. Like a podcast we're on now, and YouTube Shorts, and even the internet wasn't. I mean, it was around, but the information wasn't as plentiful then. So I mean, you couldn't just Google something to
Right.
learn. And
Yep.
there was probably a lot of real estate conferences and meetups and stuff like that, but I wasn't a part of any of those groups. So I just had to read books. And I actually still think books are undervalued. I think you can get a lot out of them. You got to sift through the ones that people have AI write, but you can, you know, there's a ton of value in books and way more than you'll get from like a YouTube short. But it's
Yes.
tough having for younger people. It's tough to get them to try to read books, but even audiobooks. I mean, there's so much value in it.
Absolutely. I agree. I feel like you just kind of disappear in the book and really become part of it. So I'm a big book reader. My husband doesn't read books. I'm like, how can you not read books? So
I can't read novels, just to clarify. I can't read like a story. I don't care what happened. I'll just watch the movie. But when it comes to finances and real estate and investing, you have to you have to you have to love whatever you're doing
yep. And
to
then
be
you can
successful.
stop and reread it if you need to. I'm a big believer in that because I'm like, wait,
Yeah,
I just zoned out for the last 3 pages. Let me go back and redo this. So,
yeah.
well, so you're reading books, you're in the library, you're doing all this. How long did it take you to get to that first deal?
It wasn't until the very end of 2006 I had to save up some down payment money, try to get, I wanted to look at like 50 or 100 houses. I wanted to look at a bunch of houses before I started making offers. But I made a few offers, of course, that didn't get accepted or someone paid more. But yet it was actually just before Christmas of 2006 that I closed on my first rental property.
Nice. Very good. So what did those first couple years teach you? I mean, if you would have had a shortcut, I don't think you had a shortcut, but what did those first few years teach you?
Well, my whole plan, multifamily was always the goal,
Oh,
but
okay.
I knew I just from all the books I read, the multifamily, and we could talk about that more, but multifamily was always the path I wanted to take. But the only path I knew or understood how to accomplish was to buy single families. And what I learned through all those single families that I owned was just the operational aspect of real estate, how managing tenants, lease renewals, maintenance requests, building at that time very small systems of handling maintenance requests. I built up such good relationships with contractors and maintenance teams, and just the whole. I think people could get a lot of value from learning how to operate property. I didn't want to be a house flipper. Like all the shows back then, HGTV, that wasn't me. I wanted to actually build a lasting business. And so I got a lot of experience operationally, I think, from those times.
Well, I think that's so very important. I work for a coaching program that all we do is teach how to buy rental properties. And I do feel like you got to start small. You got to be in the nitty gritty and have that experience. So it makes you better at who you put in that position to manage it for you when you start scaling. So I
Yeah.
agree 1,000% with that. So you made the decision, you ended up you built it up to 9 properties. Is that correct?
No,
Oh,
I think I know where you're going with this, but
okay.
I had about 50 at the time
Oh my goodness.
when I decided I probably could have done it a lot sooner to get into multifamily, but I was just kind of just one house at a time. I I ended up buying a lot of houses from tired landlords, or what I called back then, and even now we call them accidental landlords, people that couldn't sell their primary house and they wanted to
Oh,
move
yeah.
on.
Mhm.
But I would drive around the neighborhood calling for rent signs because I knew they were vacant, and I thought, well, maybe this is a landlord that's tired of dealing with this house and just would sell it. That was like my. It sounds so simple now, but at the time I thought, well, this is that was just my plan. So I bought a lot of houses from landlords, and I just kept kind of going on with that. And I just to buy a multifamily, I just didn't pull the trigger sooner. I wish I had done it sooner, but it was
Yes.
2015 that I had 52 houses, I believe, and to get the down payment money is why I had to hold that auction.
Okay, so let's talk about this auction because this
Yeah,
is the next part here. Your pivot into multifamily.
yeah,
So you decided out of those 50 plus properties that you're going to auction off 9 single family houses. And am I reading this right? At basically minimum bids?
yeah. Minimum bids was not the plan. The auction the auction went terrible. The auction company. I hate to talk. I don't want to talk bad about it. They just very much oversold me on their reach, their marketing, a nationwide list of investors, out of state investors. I honestly I could have sold them for a lot more myself just from selling to local people, but I needed the money all at once. And in multifamily, what holds people back and even for me now is the down payment. I mean, if you want to buy $1 million property, you have to come up with 250 grand from somewhere. And so this property, I didn't need quite that much, but I knew I had enough equity in these 9 houses that if I sold them, that I could raise that money myself. I never raised capital. I never asked anyone for money. I did everything myself. I didn't even know about that world or
Wow.
even comfortable doing it. So, yeah, I held this auction, and I planned to have a lot of extra money on top of the apartment, but the auction, yeah, almost all of them except for 1 or 2 went for minimum bids, but I was able to get the money I needed to close on that first property. So
Wow. So, most of the listeners probably would not pull that trigger. What gave you the conviction to do that?
just because the path that I knew I needed to take and wanted to take to break into the multifamily world, once you own one multifamily, 2 multifamilies, it's a lot easier to add value on a multifamily than it is a single family.
Yes.
The single family house, you can put granite countertops or have an in-ground pool in the backyard with a on-duty lifeguard. It doesn't matter. It's worth what the neighbor's house is worth.
Yep.
And a multifamily, you can drive NOI by getting rents up to market,
And
improving.
NOI is
Oh, net operating income.
good.
Yeah. Yeah, you got to know that term.
Yeah.
But you just operational efficiency of a multifamily, it can you get rewarded more for the effort that you put in by operating it well, keeping vacancy up, doing the repairs the right way so the same thing doesn't happen again in 6 months. And so that was just the path I knew I wanted to take to scale, and I had to let go of the 9 of the houses in order to do that. And I mean, it was 9 less roofs and 9 less properties I had to manage, but with that was 2015, I think early 2015, and within a year and a half or maybe 2 years, I had bought 3 more small multifamily properties because I was able to increase value and pull money out.
Well, I mean, many listeners know about this thing called syndication, where they pool together money to do that. And that was just not an option for you. You wanted to do it all on your own.
I mean, I just didn't think I had the credibility at that time to I had enough operational experience to walk into a bank with a 25% down payment and to get approved for a multifamily loan, considering I had all the operational and years of experience of operating property. But I didn't think I made the grade as far as getting a stranger's money 7 states away to operate a multifamily when I was brand new doing it. So, Toledo is not exactly a market that makes the front page of Yahoo Finance to begin with. We don't have beaches or, you know, sandy shores or anything to put in a pitch deck. But yeah, I just wanted to. My plan was just to grow small, and eventually. And I know guys still locally here that they have like the keep it small, keep it all mentality. But yeah, I just didn't feel comfortable raising private equity
Yeah.
until I had
No,
had a track
I'm,
record.
I'm not picking on you because I did the exact same thing.
Yeah, yeah,
Totally did the exact same thing.
yeah.
But let me ask you this. Do you believe the same, or now you believe in funds and working with other people? I mean, I know we have another discussion coming up talking about the limited partner that you were. So we'll get into that in a second. But have you changed your mindset on how to purchase multifamily now?
Oh, absolutely. Yeah,
Good.
yeah. I mean, I still look at deals here locally. I have a management team, of course, now, but the change for me was when I first started buying real estate. The ultimate goal was to gain time, freedom of time, to not have to work 32 years at a power plant, for instance. But ultimately, ironically, I suppose, I ended up having less control of my time,
Mm.
with all those units, all the operations, the tenants. And so I had more money and more net worth, more assets under management, but I probably had less control of my time. And so then I started kind of looking into how to still be active in real estate and own fractional pieces of real estate. I just wanted the economic ownership. I didn't need all that operational ownership. People I don't think understand that there's a difference.
Huge, excuse me,
Just
huge difference.
I didn't either at first.
Yeah. So I want to ask real quick about the net operating income and how to kind of improve that, because that was one of my favorite things about getting into multifamily was, like, for example, one of my coaches in the past said when he was buying apartment buildings, in the 80s and 90s, they all had tennis courts and not many people played tennis anymore. Now, I mean, this was 10 years ago. Well, 5, 6, 7 years ago. And this is before pickleball is the point I'm getting to. But
Yeah.
they would take those courts and they'd turn them into dog parks. And so that
Oh, yeah.
was just one of those things that you can increase the net operating income by doing that. What works for you by increasing your net operating income?
Yeah, that's a really good example. What I try to look when I look at an apartment, I look at it like a community. You got to try to build a community somehow. And if you have a little piece of extra land that can put a dog park on or a playground set, the last one, it was right on the property was across the street from a river here where I live locally, and it's a river, so it's waterfront, and I own the land across the street. I built this is a 20 by 30 like a steel frame deck. It took a ton of like permitting and stuff with the Army Corps of Engineers, like to drive piers into this little river. But I built this huge deck, and the tenants just loved it because they go out there in the morning, have coffee, read a book. It's a beautiful sunset
Oh,
that comes.
nice.
They have fireworks there, and the 4th of July. And so I think what you do, you put yourself in the tenant's shoes and think, man, if I lived at this property, what would make it awesome, or what would make it better? I don't look at increasing net operating income just by buying a property, then jacking up the rents by
Right.
20%. It starts with the tenant and improving the tenant's experience. People generally don't want to move. So if you can offer them good service, a good property, nice clean unit, any kind of amenity that you can add, and you can demand market rents, and that's how you drive growth, and you increase occupancy that way when you provide good service.
And Tom, most people don't talk about this. So when you mentioned that, I was like, oh, okay, this guy, I like how you're thinking, because that's half the battle, is getting the tenants in there and keeping tenants. When you have longevity, that's only more money in your pocket down the road and not the stress of the turnovers and doing all that. So I think that's a huge part of multifamily. So
Yeah,
bravo to you. Yeah.
yeah, tenant retention, keeping a tenant in a, even if it's a 1%, 2% increase, which people will come to expect if you're a professional operation.
Right.
But even at their current rental rate, you know, a lease, a renewal is worth way more than $100 increase in rent, in my opinion, because the turnover is going to cost you $5,000, three or
Yep.
4 or $5,000, even if all you're doing is carpet and paint. So I mean, I think when you provide a good tenant experience, you can increase NOI and still do right by the people that are living there.
Absolutely. So next part here, I want to get into, you've had some real trials in your life. And as I mentioned in the intro, you lost your brother who worked alongside you, and I'm very sorry for your loss. And then you later lost 6 figures in your first limited partner investment. And you said it was because you picked the wrong operator. Can you let's break it down, and what did these teach you, and how did they make you better operate for what you're doing today?
Yeah, well, that happened because the numbers, everything looked great. I mean, it was a great location, but I didn't educate myself enough on the whole world of passive investing.
And
There's
let me pause
you
you
have
there
so
for a
many
second,
options. Yeah,
because I interview people all the time who are like, invest with me, invest with me. And they want to come on here and have me promote them. And the
yeah,
listeners just think, oh, this person clearly knows what they're doing because they were on a podcast and they have this,
yeah.
so
It's
um,
ridiculous.
how do you how do you really vet these people of where to park your money?
Well, you have to look at a lot of things: their communication, their track record. The thing I learned after the first one is the guy. It wasn't like he had male intent. He didn't mean to do what he did. He just had too much other stuff going on. Like I didn't properly vet him. He had. Turns out he had like restaurants, a couple of restaurants that were probably struggling. Who knows what he put the money to? But he just was like he had all kinds of different businesses going on. So one of the things I look for when I invest in someone else's deal as a limited partner is I look for people who are very niche it down. We're an expert in the Houston market, and this is where we operate. This is where we're vertically integrated, where we have our own management team, our own maintenance team, our own community managers, and this is what we focus on. You have a group that has this great deal in your local market, and then a month later they're pitching you on a value add opportunity in Boise, Idaho. It's like, what? I thought you guys were. This is just. I like people who just are very laser focused on what they do. They don't try to be something they're not.
And then let's talk about your brother, because you worked alongside your brother. And when he passed, and it was a car accident and very unexpected, you had to take over and do double the work, I'm assuming. What was that? What was that like? Excuse me.
Yeah, one of the reasons I felt really comfortable scaling and growing with more and more units is because he was just he could do anything, very mechanically inclined, cars, houses. So I had him to really rely on for a lot of maintenance needs, especially like the emergency ones. I had other maintenance teams and plumbers, drains, HVAC guys, but my brother would handle anything that was like very critical, like right now. And then that allowed me just focus on the operation, acquisitions, finding more deals, building relationships with brokers. Um, and then when he was killed, it just was all on me. And so I ended up I ended up being like a one man show for
Mm.
5, 6 years after that, just doing everything myself, and really kind of got burnt out. Honestly, I started getting behind on certain things, building up a lot of stress, and it started to not be fun anymore. I ended up getting like a second job that I couldn't quit, if that makes sense.
Yes. And I'm sure that's a position, this is your brother, this is your family, excuse my voice today, who you trust 1,000% with everything. And so finding someone to fill those shoes, I'm sure was so difficult. So how did you rebuild after that?
Yeah, I mean, eventually you just start, rebuilding the team, and I end up finding a very good maintenance guy that will prioritize my properties. He didn't work for me. I didn't hire him, but he was just like my lead subcontractor. And it took a long time finding the right person, but yeah, me and that guy are still real good friends today, and he does a lot of stuff for me. So it took time for me to kind of get the confidence in someone again. And like my brother had a Menards, Lowe's, Home Depot card. He could go to the store and buy all this whatever he needed. And I could look at the statement and see what he always bought, like Mountain Dews and Rolos every day. I don't know what, like, there's a lot better candies out there than Rolos, but I just had to accept that. But it took me a long time to kind of build that trust back up with one guy that I could count on.
Yes, absolutely. And yes, I have looked at those receipts myself from some of my
Yeah,
subs. I'm like, oh, wait, why am I buying you safety goggles? And like, come on, you've got to provide your own stuff here. But
some let go,
yes, exactly, exactly. So I want to now move to how you are great at due diligence, because these were some major lessons in your life, which you had to do rather quickly when your brother passed away, but then also when you lost that money. So you said people invest in people, not deals. So as a fund manager, who vets the operators for a living, and what does your due diligence process actually look like?
Yeah, that's exactly the difference. As when you're buying your own properties, you're just focusing on the deal, the age of the
Mhm.
property, the boiler system, the furnaces, the parking lot. But when you're investing passively, or for me as a fund manager that places capital, yeah, you're really investing in people. You look at their integrity for one, but operationally, just their track record, and not just their track record. If a guy shows me all their deals and they all sold in 2022, that
Everyone could sell something in
yeah,
2022.
yeah, you could throw a dart at a map of your county and make a deal work back then with the interest rates and the rents being pushed. But I want to see what happened. What did they do if they were around in 2008?
Yeah.
During how did they navigate that? Everyone will love to tell you about their best deal, but you want to know about their worst deal.
Yeah.
I talk to former investors, current people that also invest alongside them, or former ones, and ask them about their experience. The underwriting, I don't know, I don't want to get too deep into underwriting, but I'm just very good at stress testing a deal. If you're looking at I'll just get the two things I look at the most are rent growth assumptions and the exit cap rate. What they're going to exit the property for. If they're buying it at a 6 and they're projecting that they're going to exit at a 4.5, then why? How are you going to achieve that? So those numbers can be easily manipulated on a financial model that have a exponential effect on the outcome. But the outcome only exists on their laptop. It's not going to happen in real life. So those are two things I look at. I look for very conservative underwriting and
Hmm.
the first and foremost, operators who get where the investor gets paid first. If the operator is getting paid based on fees, or are they getting paid based on performance?
Ooh, very good. And a big stickler for me is communication. So, we're in a tough spot right here. I'm going to be perfectly honest. We have a property that's been sitting and it's getting really tight. And, but the difference is I feel like I have a lot of integrity and I'm in constant communication with our lenders. So I think that's huge. So are there any other red flags out there that listeners who maybe want to invest in a fund of some sort that they should watch out for?
Yeah, just like I'll give you the biggest red flag is like very pushy, like high pressure tactics. I cannot stand that. Like, invest now, or we're 85% subscribed, 3 days left to fund. Like, stop that. Like, you're not 85% subscribed. If I wire you 100 grand, you'll take it. I hate when
Right.
people that kind of alerts me to, and I understand there's a marketing
Yeah, that's like a
aspect to
sales
that.
tactic. Yeah.
Yeah, I understand that has to happen at some on some level, but the pushy tactics make me believe that someone is more so in the business of raising money and not in the business of managing property. Because you can own and hold a ton of property and get paid very handsomely as just a holding company, but you're never really going to provide those investor returns. Those should be the investor, or the sponsor, the operator will make most of their money at disposition if they perform, execute the business plan properly, and get a larger sale price at the end of the hold period. So
Huge.
the pushy tactics just immediately turn me off. I just can't.
Ugh,
I hate it.
I,
Even
I,
even
I
if
me
they're
too.
well intentioned, I just don't. If I don't like to work with you, then I have to. I love the people I work with now. I fly out to their offices. I meet their families, walk the properties. They're open. They're just like an open book, and so I enjoy what I do a lot more now because I just love the relationships and building relationships.
Huge. Absolutely. So let's talk about where you are today. You're running NorthCorp Capital as a fund manager across multiple types, asset types, and operators. So, what does that look like day to day now? I know you're getting ready for some pool time with your daughter on a Friday afternoon.
Yeah.
So, what is tell me about, give us a background on NorthCorp Capital.
Well, yeah, that kind of started as a result of when I made my first investment as an LP, and it went south. The communication broke down, like you talked about. Um, And it could have been a lot worse. Me and another guy had to kind of step in and kind of take over the project just to lose less than what we would have lost. So I should write a book about that. But
Oh my gosh. Wow.
yeah, but then I really started diving in. Like I said, I fly out a lot of places every year, and as a fund manager, you get pitched deals all day. So I get the opportunity to see what a lot of people are doing in various markets to see what kind of rent growth assumptions they're projecting, what their price per unit, what they're expecting the operational expense ratios to be. You'd be amazed on what people think that they can operate a property for. It's like there's no way you can operate that property at that price.
So all this is multifamily or other types
Yeah,
of.
yeah, that's part of the multifamily part of the day. But the private credit, what we do there is we provide loans to small businesses
Oh,
that need working capital to fund their growth, hire employees, buy trucks or inventory. A lot of times it's a SBA that takes 6 or 9 months to fund, and
small. What is it? Small business
small businesses. Oh, small business association. Yeah,
associate SBA.
yeah,
Yeah.
yeah. So sometimes they'll need money now to fill the gap before that loan gets funded. So the real estate debt fund, very similar to the private credit fund in the fact or the sense that they both fill a huge gap in traditional banking.
Nice.
So my investors and I get 12% returns, annualized returns paid monthly on those two funds. They're not equity plays. They're not a piece of. They're just income funds, and that's kind of what I wish I maybe would have done different early on. I was always just so focused on growth and net worth and assets under management. And now I allocate a large chunk of my liquidity towards income, replacing income.
Okay.
You know,
So Tom, yourself, you have some multifamily property still, and then do you have any of those single family homes?
no,
Okay.
no,
So
I still have my very small portfolio myself here locally that I own, but I almost exclusively invest in other people's deals now,
gotcha. And
and
so
that
you
big
created
credit to
this.
my daughter for that. Yeah.
So you have this fund, and you have people who will park their money there, and you then invest it elsewhere. Is that
Well, it's not a blind. Just to be clear, I guess it's not a blind fund.
okay?
So if I'm raising money for a multifamily
So
deal,
you have the deal first, and then you find the money for it.
yep, and then we pool money together in this fund. Say a real good multifamily deal might be a 50 or $100,000 minimum investment, and you might
Gotcha.
get like an 8% return. Well, I pool the money together to maybe 500 or $1 million, and now we can invest together and get enhanced economics. We might get a 9% return with a better equity multiple. Same thing in the income funds. If you went to the income funds yourself, you'd only get 10%. But since I pool money together and we invest from my fund into theirs, we get 12.
Oh, very nice. So how can the Rain Nation find you if they want to park some money with you?
You can go to NorthCorpCapital.com. It's my phone number, my email on there. I answer everyone. I don't have an assistant, so I like talking to people. Additionally, I am on Facebook, but probably mostly on LinkedIn. If you just look up Thomas St. John on LinkedIn, and I'd be happy to walk anyone through my process or show them basically where I invest my money.
Okay. And do they have to be accredited investors?
Yeah, accredited investors. Yeah.
Okay. Now, I don't know if we're allowed to talk about this, but you're starting a podcast?
Oh yeah, I've had yeah. I just even talking to people like you, whether you launched it or not. I just really enjoy talking to people, like-minded people in the space that have goals, that want to build something. It's just awesome. I love spending my day like that. So I decided to kind of give podcasting a shot myself, and I have like 10 or 12 episodes. It's just I haven't actually launched yet because I want to get a runway of episodes to under my belt, so I'm not kind of rushed to get them done. But yeah, I'm really enjoying it.
Yeah. Well, I am completely selfish because I actually love that I can handpick meeting professionals in the industry. And Tom, what stands out about you to me is that you're thinking about well beyond just the numbers and really about that community aspect of things, which makes you better at how you are going to underwrite those other deals. So that's what stands out to me. And that's kind of what I'm gathering from you. So I do truly appreciate how you run your business, which
Thank you.
many people, as you will start interviewing, you will find out are not that way. They are just about the numbers. They don't care. They're going to get rid of it in 5 years anyway. That they don't want to put any, so yeah, you are going to go places. I mean it. That's going to be fantastic.
Oh well, I really appreciate you saying that.
Absolutely. What type of guests do you have on your show so far?
Real estate professionals, like I got a couple guys that are like LinkedIn gurus that understand like the algorithms, and oddly, a couple of dentists and doctors and these not just like guys, doctors that like have real big goals and dreams of curing Alzheimer's, and
Oh, wow.
want to have a lot of doctors and dentists who have invested passively. So I think that's why they, you know, want to be on the show. But yeah, just really, I'm kind of just amazed by some of the guests. Like I don't even belong in the same room as some of these people. These guys are trying to change the world.
Yeah.
I'm just trying to change my investors' world. These
Yes.
guys have huge goals and dreams, and so I'm having a lot of fun, learning a lot too, talking to some of these guys. Like wow, you know.
Yes, I agree. Absolutely. So this has been so awesome. I want to move to the second, my voice is shot. I want to move to the second part of the podcast here. There goes my camera. And I use the acronym BADASS, which is what makes Tom a badass. And the first letter is B for book. You put a really high bar here because Mr. Library Guy at the beginning of this conversation. Yeah. So I want to know, what's a book that made a huge difference in your life?
I thought about that from the questions, and so I do have a book picked out. A lot of people read Rich Dad Poor Dad, which of course everyone should read that.
Yes.
But if there's people getting into real estate that are thinking about starting it, and newer investors, what I would tell them is a book by Burke Hedges. It's called Parable of the Pipeline. Parable of the Pipeline.
Okay.
It's a real thin book. When I was first going through the library, there was a lot of thicker books, and I was like, I'm looking for the smaller one to start with, one I could digest. And that book, I have probably 10 or 12 copies of it in my office at all times because I just give them to people. But yeah, Parable of the Pipeline.
I have to check that. I've done over 300 of these episodes. That one's never come up, so I like that. I like the title too. Yeah. All right. The first A in badass is for advice. What's the best piece of advice you've ever received?
Best piece of advice I've ever received?
Yeah.
Yeah, is to build a team. And like, I guess the way a friend of mine put it, he said, hire yourself. And so as far as like asking for help and building a team of people not just to delegate tasks, but just so you can focus on what you're good at. Like, I'm not a tech guy. I can't copy and paste a download, a file into this format. I don't know what you guys are talking about. And if I Google it, I don't understand the Google instructions anyway. So you find people who are good at what they do and put them in places that they can be successful. People, you have to love what you're doing in order to be successful. If you don't like cutting grass, you can never have a lawn care company. So I think if you put people in positions that they enjoy doing, it's going to help you grow.
And I feel like that's such a bottleneck for small business owners is because they feel like they have to do everything themselves. And, a book that changed for me was Who Not How. Have you
I
read
got
that
that.
one?
Oh yeah, yeah.
Oh my gosh, that one was, and that's where it just clicked. I'm like, I am wasting hours learning Claude. We started talking about Claude at the beginning of this call, and I'm sure I could just have someone just. So I am starting to do more YouTube videos. Oh, that's what that means. So,
Dan Martell has a really good book too called Buy Back Your Time.
mm, I have
And
heard that one.
yeah, he
Yes,
talks about if you're $100 an hour CEO, and don't do $20 an hour tasks because you're
yep,
costing yourself $80 an hour in productivity. Kind of along those same lines.
huge. But also going back to the stories you were telling before, when you do the things, it makes you better at teaching others to replace you in those positions. So a little bit of both there. So, all right, we're
Yeah.
moving on. So the D in badass is for drive. What drives you to be successful?
A little 3.5 foot tall, little blonde haired girl. That's what drives me. My daughter. I just want to give her a shot at something that I never had as a kid, to live a life of meaning, and where she doesn't, not that having a job is a bad thing, but I want her to do things that she wants to do to help other people and be impactful, and not just be tied down to just a W-2 job kind of making ends meet. But yeah, she drives me and motivates me for everything. Spending more time with her and just giving her things. She's really spoiled, so I have to work on that later, but I want to get her spoiled first, and then I'll figure it out from there. But she's
Well,
always been my motivation.
I had the pleasure of meeting her as we were
Yeah.
getting set up here. So, and I do know there's pool time coming up, so we'll keep going here. The second A in badass is for aspiration. I'm a big goal setter. So, what is a goal you are currently working on? Can be business, personal, whatever.
Yeah, one of the funds that was launched about 9 months ago, I just set a personal goal to raise $5 million for that fund. Um, all the investors will get 12%, and to me, it's not really about the $5 million. It's just about, for me, $5 million is maybe 50 or maybe 100 more people that I can help. I'm just so passionate about investing in private markets as opposed to the public markets, i.e., the stock market.
Mm-hmm.
The volatility and the just all the market sentiment that you can't control in private markets, or I mean in public markets. So I want to be like one of the voices of encouraging people to invest more in private alternatives. So the 5 million is kind of just a number I threw out there as a goal, but it's really more about helping 50 to 100 more people.
And it makes it more personal too.
Yeah,
Everyone can invest in this SpaceX stuff here, but it's when you're on the personal side of things, or the private side, definitely a lot more personal, and feeling like they're really part of something. So I like that. So, all
yeah.
right. The first S in badass is for systems. What systems do you have in place to help you achieve success? And I know it's not technology.
Well, I do have I mean, there is, as a fund manager, you have to have an investor portal. That's not optional.
Right.
You have to have a way for people to, and I have built those systems with a great company, TribeVest, who helps automate, or well, not really automate, but like all the subscription docs, the private placement memorandums, all the entity docs, the banking, the distributions. So I have built that system out over the last several months or year, I suppose, to just to make the investor experience so seamless and easy. That way they can just talk to me, build a relationship, and we don't have to worry about where a wire's coming from or a distribution. Everything's automated. But in the communication with the investors, which is so important, those are the types of systems that I've gotten really good at, and I'm just still constantly trying to figure out how I can do better.
See, you got tech on your side. You got this.
Yeah, I had to hire an actual company though to do it, but yeah, yeah,
Well, I could talk to you all day. I think it's the water in Ohio, because my people that I interview from Ohio are always fantastic people. And
It's the Great Lakes. Yeah.
It is the water then. All right. Well, thank you for solving that mystery for me. All right. Well, the final S in badass is for success. What does success mean to Tom St. John?
I was talking to a guy about this not that long ago, and success means to me isn't success at all. It's significance. You can be successful in life, wildly successful in life, without ever being significant. And I think Tim Tebow might have said that. I don't know, but success is just defined in money or lake houses or how fancy your boat is or how your assets under management. But significance is measured in people. How many people have you helped? How many people have you had a positive impact on? How many people owe you a thanks? So that's kind of what success I define it by now. Is I've had some success in real estate, but I focus more on being significant.
And I know one of them is waiting for you in the other room. So Tom,
Yeah.
This has been such a great interview, and thank you for giving me a few extra minutes at the start of this. I was not prepared. So yes, this was such a great interview. One more time, how can the listeners find you?
Just go to NorthCorpCapital.com. I got some free resources on there you can download for free. And just shoot me a message. You can also find me mostly on LinkedIn. Just connect with me on LinkedIn. You can also subscribe to, I have a newsletter I publish about every couple of weeks on LinkedIn. And I'd love to talk to any one of your listeners.
And hopefully a podcast coming out soon. So Tom, it was such a pleasure meeting you. Thank you so much for being here today.
Yeah, thanks a lot for having me, Jen.
Absolutely. And that is all. Thank you for listening, and we'll catch you on the next episode. Now go out there and share your badassery. And don't forget, make it a great day. Take care. Bye-bye. Whoop, whoop.
Thank you for listening to RAIN, the Real Estate Investor Growth Network. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. If you need more badassery, you can follow Jen Josie by visiting therealjenjosie.com or become a member of RAIN by registering on rainmastermind.com.